You submitted a strong file. Your business is running. The numbers make sense, at least to you. And then the email comes. Thank you for your application. After careful review, we are unable to proceed at this time. No real reason, no roadmap, just a polite door closing in your face. If that has happened to you, you are not alone, and more importantly, it does not mean your deal is dead. It usually means you sent the right file to the wrong place, or you sent the wrong version of the right file. Today we are going to pull back the curtain on how lenders actually think, the tests they run, the reasons they never put in writing, and exactly what to do next. Welcome to the Equus Capital Finance channel. We are a commercial capital advisory firm based in the Greater Toronto area, and we work with real estate owners, developers, and mid-market businesses across Canada and the United States. Every week we see declined deals that should not have been declined, and today we are going to tell you why that keeps happening. Let's start with the single most important thing to understand about lenders. They are not asking whether they like your project. They are not impressed by your vision deck. They are asking one very specific question. Will this borrower repay us in full, on time, even if things get difficult? Everything in your file is being read through that lens. Most lenders use a framework called the 5 C's of credit. Let's walk through each one quickly. First is capacity, your ability to actually service the debt. The number lenders care most about here is called the debt service coverage ratio, or DSCR. It compares your net operating income to your total debt payments. Most commercial lenders want to see a DSCR of at least 1.25, meaning your income covers the debt by 25% above the minimum. If you come in at 1.10 or 1.15, a lot of lenders will stop right there. Second is credit, both personal and corporate. They are looking at your payment history, how much of your available credit you use, past bankruptcies, and collections. Clean and steady is what they want. Gaps and late payments signal stress. Third is capital. How much of your own money is in this deal? Lenders want to see real skin in the game. If you are asking for close to 100% financing, or if there is almost no cash buffer after closing, your risk score goes up immediately. Fourth is collateral. What assets are securing the loan? They will look at current market value, how liquid those assets are, and how many other lenders already have claims ahead of them. This is where loan-to-value limits come from. And fifth is conditions, your industry, your region, and the lender's own internal exposure. A perfectly strong file in a sector the lender is already overweighted in can still get declined. That is a portfolio decision, not a judgment on your business. And here is something most applicants never think about. Before a single ratio is calculated, underwriters are judging the file itself. Disorganized packages, missing schedules, numbers that do not match across documents, these signal risk before the review even starts. The most common red flags we see are different revenue figures between tax returns and internal statements, missing notes for major line items, and unexplained large deposits or withdrawals in bank accounts. Now here is where it gets honest. The letter says, does not meet our guidelines. The internal notes say something very different. Let me walk you through the 6 real reasons we see most often when we review declined commercial deals. Reason 1, cash flow did not clear the line. Your income looked strong on paper, but once the lender adjusted for one-time items and recalculated owner compensation their own way, the DSCR dropped below their floor. A lot of borrowers are shocked to find out the lender's version of their income is meaningfully different from their own. Reason 2, your documents told different stories. Tax returns, financial statements, and bank records all need to paint the same picture. When the numbers do not line up, or when something is simply missing, the lender assumes you are hiding risk. Self-employed owners experience this the most, because their income runs through several different channels. Reason 3, wrong lender for your deal. This one is critical. and it is completely fixable. Not every lender funds every type of deal. A major Canadian bank may have no appetite for small mixed-use retail at this point in the cycle, while a private lender may be actively seeking exactly that profile. When this is the issue, it has nothing to do with your deal quality. You were just in the wrong room. Reason 4. The proposal did not make a clear case. Underwriters need to see exactly how every dollar will be used and how that use connects to future cash flow. When the file just says, working capital, or shows projections without any real market data behind them, the credit team has to guess. And most will say no before they guess in your favor. Reason 5. Sector or portfolio exposure. Some industries fall out of favor with certain lenders for a season. Hospitality, small retail, and certain types of construction have all gone through periods where major lenders quietly stopped putting more on the books. If the lender is already heavily weighted to your sector, your strong file still gets declined. The official reason will be vague. The real one is that the cupboard is full. Reason 6. Collateral and lien issues. Even when cash flow works, the lender still needs adequate security. If the property is already pledged, the equipment is older than their policy allows, or your loan-to-value is outside their comfort zone, the file stops there. Asset-based and private lenders may still be open, but your first lender is unlikely to point you toward them. Think about the gap between what you are told and what actually happened. Your application does not meet our guidelines, often means the DSCR came in at 1.12 after their adjustments. We are unable to proceed at this time, often means the bank hit its internal limit for your sector this quarter. The file does not fit our risk appetite, often means equity was under their minimum and collateral was already heavily leveraged. Once you see it that way, a decline stops being a mystery and starts being a technical report, and technical problems have solutions. So what do you actually do after a decline? The worst move, and we see it constantly, is taking the same package and sending it to 5 more lenders, hoping someone is in a better mood. That approach adds hard credit inquiries to your record and often makes the next lender more cautious, not less. The right move is to treat the decline as data and rebuild. Start with DSCR. Recalculate it using realistic, lender-style numbers, not your best-case scenario. If the ratio is too thin, look at whether paying down smaller high-interest debts, adjusting the amortization schedule, or increasing your equity contribution can move the number. This single step moves more deals from declined to approved than anything else we do. Then review your tax returns, internal financial statements, and bank records side by side. Anywhere numbers diverge, add a clear, brief explanation. Lenders are not necessarily suspicious, they just need the story to hold together. When every document supports the same picture, the whole file reads as lower risk. Next, build a proposal that reads like a serious document. Include a clear use of funds schedule, grounded financial projections with the assumptions behind them, and a brief overview of your market and competitive position. This is one of the most direct ways to eliminate a decline that was really about presentation, not fundamentals. Then look hard at your collateral. List every asset that could back this deal, current fair values, existing liens, and encumbrances. In some cases, bringing in a partner, pledging a different property, or restructuring toward an asset-based facility can fill the gap the first lender walked away from. And finally, match the deal to the right lender. Banks, credit unions, insurance companies, pension funds, and private lenders all have different risk appetites at different points in time. This is where having an experienced intermediary matters, because very few owners have the time or market access to track all of those moving parts. At Equus Capital Finance, this is the core of what we do. Most of our clients come to us after a surprise decline. They want to know what really happened, and they want a clear path forward. We run every new mandate through our Project Navigator process. which is essentially a pre-underwrite of your file before it ever reaches a lender. We test your DSCR, review the security package, stress test cash flow under different scenarios, and flag every weak spot in the structure and story. The output is a clear determination. Is this deal financeable as structured? Does it need to be restructured? Or is this not the right time? That clarity saves months of wasted submissions and protects your credit profile. From there, we work with a broad network of capital providers across North America: banks, credit unions, insurance companies, pension funds, trust companies, and private lenders, and we direct your deal to the channels that are actually open to it right now. We also structure deals that do not fit a standard box: asset-based lending, mezzanine debt, construction financing, subordinated debt, and working capital facilities. For a lot of clients who ask why their deal was declined, the honest answer is that the structure they requested was too narrow for what their project actually needed. Our team has been doing this for over 2 decades, on commercial transactions ranging from $1 million to $500 million. Here is the bottom line. Most decline letters read like the end of the road. They are not. In almost every case there is a specific, solvable reason why the deal did not go through, and once you know what that reason is, you can address it. The key is to stop treating a decline as a verdict and start treating it as feedback. If a deal that matters to you has been turned down, reach out. We will review the file, tell you what we actually see, and map out a realistic path forward. Our contact information is in the description below. And if you found this video useful, subscribe to this channel. We put out practical content on commercial financing, deal structure, and capital markets for business owners and real estate investors every week. We will see you in the next one.